Welcome back to our workshop series about home buying with making an offer, negotiating terms, and determining mortgage options, part 3. And this is hosted by Jericho Road Community Health Center at Hope Refugee Drop-In Center. My name is Leanna. We welcome back our presenters, John and Adam. John is born and raised in Buffalo and has experience over 25 years in the restaurant business, making customer service and hospitality his strong suit. He has been in real estate for over 5 years and has had great experience learning from many Keller Williams agents and teams over the years. He also has great experience working with and helping people from different cultures as refugees find the perfect home. John has toured more homes in New York, Western New York than your average negotiator, whether it's navigating the way for first-time buyers, trying to get the perfect distressed property, or providing help in the luxury market. He is here to help. John specializes in discussing the best terms and guiding the purchase and sale process every step of the way, right to the closing date. And then Adam was also born and raised in the Buffalo area, and he values honesty and trustworthy approach with his clients. He takes pride in helping clients better understand the mortgage process inside and out to eliminate surprises and streamline their closing costs. He has the experience as a mortgage processor and underwriting trainer prior to venturing into mortgage sales. This background helps further relate to all aspects of the mortgage process and allows clients to feel better informed throughout the process. Adam is available before and after normal working hours, as well as weekends, from first-time home buyers to those seeking investment opportunities and those looking for their forever home. Adam has worked with all types of clients over the almost decade in the industry. Let me share my screen so we can look at the slides. All right, John, if you want to take it away.
All right. Good afternoon. So after we've the buyers looked at a home and they like the home and they want to put an offer on a home, which is the process is putting an offer on a home. And that is basically, from my perspective, is talking to the buyer, determining how much, what kind of an offer they want to put on a home. If it's like $150,000 list price, how much do they want to offer on the home? Nowadays, it's more like a bidding kind of situation versus just putting an offer on the home. A few years back, you just, listed at 150,000. I'll just put an offer in at 150,000 and see if the seller accepts it. Nowadays, with this market and low inventory, the listing price is pretty much the starting point on a home. And in most homes, in the average, anywhere from 10, could be 10 offers on a home to 60 offers on a home, sometimes more. So it's important as a real estate agent to advise my buyers, how to go about putting an offer on a home. And basically it's, if it's a list price of 150,000 and say there's 20 offers on the home. So then as an agent, I talk to the listing agent, find out how many offers they may have currently in their office, how many do you anticipate getting in, and kind of ask what's important to their seller in terms of details on the offer. Is it quick closing? Is it do they need an extended period of time to close? Is it different things like that. It's not always about the money, it's about the terms of the contract. And nowadays, a lot of people are paying cash and or financing. So as an agent, try to find out kind of like as much as possible to the importance. So on a home that's at $150,000. So once I get all that, I again talk to the buyer, and usually there's a deadline of say like 2 p.m. on Wednesday to put an offer in. So, a few hours before that, I'm finding all that information out. I converse with the client. We go over the details of their offer, how much they want to put on the home, how much of an good faith deposit or earnest money deposit they want to put down, and discuss, if they want a home inspection or not, different things like that and all that. And once we've talked and got all those details out of the way, I proceed to put the offer together so that I can send it to them via email for signature. And once the offer, like I said, once the offer is written, I send it to the buyer, they sign off. And then once I get that back from them, I will proceed to send it to the listing agent, all the necessary paperwork, how much the offer is, and all that. And then wait for, usually, if offers are due at 2:00, a lot of times maybe they're not presenting offers till like 6:00 at night. So it'll be a few hours before we hear anything back from the listing agent and all that. So yeah, and all that. So then once the offers are presented, generally the listing agent, okay, I guess I go. Okay, then once the listing agent gets that offer, they'll sit down with the seller on phone or in person and present the offer. And they'll go over with the seller not only the offer price of my buyer's offer, but also the various terms of the contract in terms of, do they need any what we call seller concessions, which sometimes sellers or buyers will need help with closing costs, and that, and then if there's anything called contingencies, basically meaning, does a buyer need to sell a home before they can purchase that home? That those are two things that sometimes are a negative in a seller's eyes, because they worry that maybe the buyer's not as financially sound as a person who doesn't need any seller concessions or contingencies, in that respect. And then, also they'll explain what the earnest money deposit is, which nowadays, generally, if you can put about 3% of your offer price on the house, that's good, because that shows that you are, strong financially. And in the eyes of a seller, that's just as important. That's important. So they know that down as the offer is, as the deal goes through, there's the less likelihood of the buyer needing to back out. One of the other things then is the agent tells the buyer, or the seller, is whether or not the buyer wants a home inspection. And there again, I always recommend to a buyer to do a home inspection on a home, so they know the condition of the home. Sometimes what we'll do is put in their home inspection, but only for informational purposes only, meaning that we'll do the home inspection, but we're not going to ask that seller for any type of repairs, credits, or anything like that to put them at ease. The buyer just wants to know, the condition of the home. Is the roof, how does the roof look? The windows, the basement, the foundation, the electrical, the mechanicals, and so forth. If there's anything serious, in terms of, a safety hazard, then that's still, we may try to negotiate that, but basically by doing that kind of inspection puts the seller at ease, and they're not as fearful of a home inspection, because a lot of times they think a home inspection, a buyer is going to ask for a long list of repairs. And that's the key in this market, is to the home inspection is not a negotiating tool. It's more of an informational phase of the home buying process. So next slide. All right. So say that once the seller accepts the offer, everyone is happy. That's right, especially the buyer, especially if it's like, 15 houses later and 5 offers later, they finally are able to get that dream home. So as soon as both sides, so then once the seller says, yes, we're going to formally accept my buyer's offer at $150,000, that seller then will sign the paperwork, the contract, and all that, generally the same day or within 24 hours, depending on where the seller is, if it's whether by in person, or it could be via email, depends on that situation. So once that's all done, it becomes an official contract. All right. And the buyer is on their way to the closing process of a home. But, in some cases, what happens, maybe the seller says, hey, you offered $150,000 and they have another offer that's like at $153,000. They may come back and say to me as the agent, and the agent will come back and say, would your offer is comparable to another offer. Would your client be willing to up their offer on the home? So what happens is I go back, I talk to the buyer, say, hey, explain them the situation. Our offer is, pretty close to another one. They're asking if you'd be willing to come up to, like, say, $155,000. Talk to the buyer, and the buyer says yes. Then I let the agent know, and and the seller accepts that. Then we move on. There starts the process. But okay. In the other case, the seller may decline the offer. Maybe it's because if it's a multiple offer situation, and generally when you have more than 3 offers on a home, there is not that opportunity to put a second, to increase your offer. Generally in a multi-offer situation, we're putting in what we call our highest and best price on the home. The reason is if there's 15 offers on the home, the agent, there's not going to be that opportunity for the listing agent to go back to 15 different agents and ask, do you want to change, up your offer or anything like that? So basically what happens, the seller makes a decision on the offer that they feel is the strongest and most financially sound to them. And then, generally a lot of times, I've got that call from the agent saying, hey, your seller, your offer was very strong, but the seller has accepted an offer that was higher than yours. So yes, that can be a little disappointing to buyers a lot of times, but on the same token, I use it as a way of trying to make their next offer better. I'll ask the agent, where did I stand in the offer? Was I like number 2, number 3? How did my offer compare to the winning offer in terms of details? And I'll take those details, and I'll let my buyer know, hey, next time we maybe need to go a higher earnest money deposit, or maybe instead of only going $20,000 over, we may want to go like $25,000 over. So little things like that to make our offer stronger down the road always helps. Okay, next slide. Okay, what is an offer letter? Basically, when I send an offer to the listing agent, it's all the contract, agency disclosure, possibly lead paint disclosure, etc. paperwork. It's all signed by the buyer, and with that, in an email, I will basically describe the terms of my buyer's offer for the home. I'll generally, if it's a financial, if it's going to be finance, I'll let them know. If it's conventional, FHA or VA, obviously what they're offering to pay for the home, whether or not there's any seller concessions, any contingencies, which again, seller concessions are if they need help basically with closing costs, which can be put in towards your mortgage as well. Contingencies being, they, may need to sell another property to buy that home. So that's in there, letting them, basically it's a summary is what the offer letter is. And I'll let them know there, earnest money deposit, whether or not there's a home inspection. And pretty much those are the main things, basically just summarizing the offer. So when the agent does have to look at multiple offers, especially when you get 20 or 30 offers, it kind of helps them, they can just take my offer, hopefully just, they'll read the contract, but at least by me making a offer letter and summarizing my offer, I'm looking to make it their job a little bit easier, and so forth. All right. All right, and once an offer is, okay. Okay, let's see here. And also in that offer letter is generally the amount of, down payment on a home. Generally, the rule of thumb is to try to put 20% down so that you're avoiding what they call PMI, which is like basically like a mortgage insurance on the loan, which is an added cost each month to the homeowner, to the buyer. Okay, and then the paperwork is also the pre-approval letter. Okay. All right. And there again, as you can see from the example here, basically it talks about the details of the offer that's presented to the seller, so they know. And then there's usually an expiration date, which is anywhere from roughly 24 to 48 hours is on it. All right. So once an offer's been accepted by both sides and signed, and then it goes. All right. Then it goes to an attorney for both a seller's attorney and a buyer's attorney. Basically, we call it attorney approval process. And what that is, the attorneys go over the entire contract line by line with the buyers, making sure that everything in that contract has been filled out properly and that the buyer fully understands it. The contract totally, all the details, the price, the contingencies, and so forth. And those generally, an attorney has up to 3 business days to give their approval or disapproval of the contract. Generally, rule of thumb, unless something comes up, maybe, and it's more from a buyer standpoint, generally, an attorney will approve an offer. Very seldom do they decline it unless, maybe the seller all of a sudden gets cold feet or something. There's got to be some legitimate reason why, or something comes wrong with the home inspection. All right. All right, next slide. Okay, what are contingencies? Conditions in the offer letter that sellers should, standard contingencies are an appraisal. If an offer is being financed, specifically if it's like an FHA or a VA type of loan, there's generally an appraisal done by the bank or mortgage lender on the home. And what that is the bank comes out, sends a representative out to check on the property to determine the value of the home, to see if the value of the home will at least meet the offer that's being accepted on it. So if the offer on the home that's accepted is $150,000, the appraisers are going to come out and check out the condition of the home and the area and look at sales in the area around the home to see if the appraisal will meet at least $150,000 offer on the home. Sometimes they do, sometimes they don't. And with the appraisal, sometimes they may require certain repairs to be done on the home. Might be taking care of a smoke alarm or something is missing, maybe some paint, chip paint that's needs to be touched up, things like that. So that's down the road. That's, a couple, usually about 2-3 weeks in the process. But once the offer is, while the attorneys are looking at, doing their thing with the offer, and then if the buyer has wants to do a home inspection, I, as an agent, generally within about 3 days of the offer being accepted nowadays, we try to do those as quickly as possible because sellers are like, recommending, to get it done as soon as possible. So, in case there's any issues or concerns. And a home inspection, as mentioned, it's done by a New York State licensed home inspector who is hired by the buyer, and they come out and they totally check the house from the foundation all the way up to the roof, and they'll check everything on the outside and the inside of the home. Outside, they'll check, the condition of the building, the foundation walls, windows, doors, generally kind of overall view of the property outside. If there's a garage, they'll check that out as well, to see and verify the condition of the garage. And when it comes to inside, there again, generally most home inspectors will start from the basement on up. And in the basement, they'll check the foundation walls. Is the basement, is there any water coming in the basement? Is the home structurally sound? They'll check the mechanicals such as the furnace, hot water tank, the circuit breaker panel. If there's central air, they'll check that out. So and that's usually the most time consuming part of the home, is because they're checking out all the mechanicals, the structural and the foundation of the home, plus the plumbing and so forth, and then work their way up to the house. And as they go through each room, they're checking out windows, the condition of windows and doors. Do the windows open? Do the doors operate properly? Are all the electrical outlets working properly? Checking the faucets, the water, checking the faucets in the kitchen, dishwasher, stove, things of that nature, making sure everything is in working order as they go through the home. Then, as they proceed up to the second floor, they're doing the same thing. And when they get to the attic, if there's one, still checking that condition. They'll look to see, is there any roof leaks? Is there any water coming in? What's the condition of the roof from the inside of the home? And generally the overall condition itself. And generally a home inspection takes roughly 2 to 2.5 hours to complete, depending on the size of the home. And once that is done, the home inspector will write up a report, and generally along the line takes a lot of photos, takes any photos necessary if there's any issues or concerns, and puts that report together. He will go over it with the buyer at the home. Generally, we'll talk about things as we go through the home. So, the buyer is getting pieces of information as the home inspection is conducted. And in the end, he'll kind of review the important thing. If there's any important issues, review those with the buyer, and then answer any questions or concerns the buyer may have about the home once that's done. And sometimes, depending on the inspector, the buyer may get a copy of that report right there, right after the home inspection, or some home inspectors will email that report later in the day to the buyer, so they have a record of it, and it'll include photos, notes, concerns, and the overall condition about the property, plus other miscellaneous information about the home, like how to maintain a home, how often to get the furnace cleaned and checked, what to do, what different things you should do each month, each season, basically giving that buyer as much information as possible to help maintain that home in good condition as they own it, so that, keep it, so there's they can, that, maybe when the roof, how long it should be before the roof gets replaced, or different things. So a home inspection is a combination. Basically, it's a roadmap, the condition of the home, and also how to maintain it, which for first-time buyer is very important and helpful in that respect. And I do, as an agent, a lot of times attend those home inspections, mainly for educational purposes, and also sometimes when buyers feel more comfortable with me being there, and maybe to answer questions as we go along. And now that, all right. And then another contingency, like I think I mentioned, is financing. I don't know if I'll let Adam touch base on that when he comes on. He can explain that a little bit more. And then the home sale, which basically is, if a buyer has to sell their current home, they're going to say, okay, my home's on the market, and once that home, once I sell my home, I'll have the funds necessary to fund the closing on this home. And generally what we try to do is get their home sold and closed at the same time this one is, so that, it also will help hopefully put the seller at ease, because, hey, you're closing on my home on May the 1st, you're looking to close your home maybe on April the 30th. So, it'll be kind of like corresponding, put the seller at ease that, hey, the buyer will have the money to finish out the closing on the home. But there again, those are things that sometimes the seller, worries the seller, so they'll stay away from it. Next. All right. How to negotiating the price of the home. And there again, a lot of it has to do with how many in this market, which is basically a seller's market, it has been for like the last year and a half, is determining, how many offers are in the home, what the homes are selling for in the area of that home, to try to plan the best possible offer, because, as an agent, I want to get the home. I want to get my buyer a home for the best possible price in the quickest time. And I don't want to, put them in a position where they're overpaying on a home, because down the road, if they go to sell the house in a few years for any reason, maybe they got to move away or job relocation, whatever, be able to sell that home and get the money, they paid for, but also an extra one. Sometimes people, if they overpay on a home, and they have to sell, they go to sell their home 3 years later for, let's say they get a job offer to move out of the state and they paid $170,000 for the home, but yet and depending on the market, maybe if they paid 170, they're probably going to look at paying, selling it for around $200,000, because they've had it 3 years and they've done some work in the home, and maybe the market may not bear that $200,000 price tag. So the buyer, when they're selling the homes, is risking the chance of, not making as much money or taking a loss on the home. So that's why it's important as a real estate agent, I, do my best to advise them how much to put on the home, but also get as much information as possible to make that offer as strong, but yet financially responsible. Because as I teach, as I mentioned to buyers, there's don't want to put somebody in a position where they're being house poor, meaning, they get the home at a price, but then they're not able to move forward with anything, doing any, upgrades on a home or furnishing or anything like that. I don't want a buyer to be in a position where they have to change their everyday life, their day routine and so forth. Okay. Next. Okay. Negotiate the overall price. The best thing is to not have any contingencies or concessions at all. No need for closing costs, any contingencies such as selling your home, or that's the big one, is needing to sell your home to buy one, or being able to close at a proper time. A clean offer, or an offer without any contingencies or concessions, will be a lot stronger in the seller's eyes. So if you're asking a seller to help pay for certain closing costs or waive certain closing costs, that's they see that as losing money on the home. So like I said, a good offer is basically no concessions, contingencies. Cash, which is a pretty strong option these days, and a lot of people are paying cash. But sellers do seem to favor cash in a lot of situations, because they're getting their money a lot quicker. Generally within about 45 days, a deal can be closed for the most part. There's no bank involved, so they don't have to worry about any appraisal costs or anything, even though somebody paying cash still might have a home inspection, or a home inspection as a peace of mind. Sellers are, see that as a stronger situation, because they just see the deal going done faster and quicker without any problems. So with that, next. All right, leave it up to, it's your turn, Eric. Adam.
All right. Hey guys, thank you, John. That was awesome. Very informative on the purchase process. Now I'm here to kind of talk to you guys a little bit of what the mortgage process entails, kind of what to expect with a mortgage. So, I mean, what is a mortgage first and foremost? It's a type of loan or sum of money that you borrow from a lender that helps you buy a house. So in this instance, if you don't have the cash or don't want to spend all the cash that you have in order to buy a property, this allows you to borrow some of those funds, up to a certain amount, depending on what type of loan product it is, in order to purchase that property. Typical types of mortgages we can do different types of terms than just 15 or 30-year terms for conventional loans, but for the sake of this, those are the most frequently used. So conventional, you're typically looking at a 15 or a 30-year term, and then your unconventional types of loans, which are your government loans of the FHA and VA. We'll go into more of that next. We'll go to the next slide. Okay, so with the conventional loans, again, we're focusing on the 15 and 30-year fixed terms. With a 15-year term, you obviously have to pay the loan back within a 15-year period. It has a higher monthly payment because obviously you're going to be condensing down that payoff of whatever your loan amount is from 30 years to 15. You're cutting it in half, so your payment's going to be slightly higher, but generally you get a two-pronged approach, I should say, in terms of what's going to be benefiting you. And the first thing is obviously you're paying off your mortgage quicker. And secondly, you're going to have a lower interest rate. So you're going to accrue less interest over the period of time that you do have the loan out there. And a 30-year term is usually going to have a higher interest rate. So that also will benefit you as well. You're paying a little bit less in interest monthly. With the 30-year fixed rate, obviously the payment's the lowest it possibly can be then, right? So you're paying it back over 30 years. The interest rates are slightly higher, but it gives you a couple of different options there as well. For instance, it helps you keep more money in your account month to month, so you don't have to make that larger mortgage payment. And a lot of times what I tell people is if they're on the edge between that 15 and 30-year term and they don't feel super comfortable at 15 years, but they don't really want to take 30 years to pay it back, you can always make extra payments every single month towards the principal, or not every single month, a couple times a year, and that will help dwindle down the amount of years you actually pay on that 30-year mortgage. So you could pay it down faster, and that will obviously cut down on the total amount of interest that you will pay. Or the other thing that it will do is give you the option that, say, you typically could make the payment for a 15-year term, but you go with a 30-year mortgage. That'll just help you in certain times when, say that 1 month you just have more expenses than normal and you need to come up with a lot of extra funds. You can make that minimum 30-year mortgage payment because you have that ability, because you technically with a 30-year mortgage, so it's a lower payment. It will give you that extra cash to use on things that you may need, personally or for your household. It just keeps that extra money in your cash in times of need. And like I said, you can always make extra payments to the principal in the 30-year term to pay that mortgage down quicker. So sometimes when people are on the edge, I just try to tell them, listen, go to the 30-year term, pay the extra principal amount when you can, and then those months when you can't, just swing it. You have the ability to make that lower payment. So it can kind of two-pronged, twofold help you there as well. So very much benefits to both of them, and it just depends on what's going to be the best for your scenario. We can go to the next slide. All right, so these are just a couple of examples between a 15 and 30-year loans. So you're going to see that everything's pretty much the same in each example: your total house price, your down payment, and your mortgage loan. And then based on the amount of interest that you're paying, in one example, it's 3.5% with the 15-year, and then 4.5% with the 30-year. Obviously, paying it back over 30 years, and that's at a slightly higher interest rate, you're going to be accruing a lot more interest. So based on that $120 mortgage amount, you're actually going to be paying back $156,000 in your 15-year term, and then $216,000 in your 30-year term. So that shows you that how that interest compounds after time. And the longer time you have that mortgage out, you're actually going to be paying more just in the fact that you're paying interest, which is another reason why a lot of people try to go to that 15-year term, or if they are in that 30-year area, they just make extra principal payments so they can pay it off years earlier, and then, you know, obviously remove paying some of that huge amount of interest over the life of the loan. So again, there's benefits and negatives to both of them. Really just depends on what is going to work best for your individual scenario. And both options are good for you. It just depends on, you know, where you'd like to be and how you'd like to hedge your benefits going forward. So next slide. This is just kind of a breakdown of showing you what the difference is between the 15 and 30. So instead of it being spelled out, this kind of just shows you the bar graph, you know, how much percentage you're paying in interest versus principal on both loan terms, whether it be a 15 or a 30-year. And this is obviously with the expectation that you're going to pay it back within the actual time frame of the term, so that you're going to pay it back in an actual 15 years. You won't pay it off early, and then 30 years, same thing with that. So you can see obviously the 30-year mortgage comes with a ton of a lot more interest paid if you make all your payments, you know, consecutively in that 30-year term and don't make any extra payments there. So we can go to the next slide. All right, so then you have your unconventional loans. So these are also known as your government loans. And there's a lot of different benefits to these ones as well. The first one we'll go over is your FHA loan. The nice thing about an FHA loan is that you can do as little as 3.5% down. So it really helps you save some of that extra upfront cash in your pocket. And it helps a lot of potential buyers because this is good for, you can do a 3.5% down on a single family home all the way up to a 4-unit primary residence, as long as it's a primary residence. So it's really nice. Not a lot of other products give you the option to do only 3.5% down and buy a 4-unit primary residence, where you can also get that proposed rental income, you know, month to month from the other units being rented out. So that's one of the huge benefits of FHA. Aside from that, FHA also is not as harsh on your credit. So if you're somebody that has maybe in that lower echelon of credit qualifications, you know, that also helps you with FHA, because FHA they're not as strict when it comes to your credit qualifications in terms of interest rates. So typically with a conventional loan, the lower your credit goes in the different tiers, the higher your interest rate goes. Well, with FHA, they're not as harsh when it comes to that, and they have much wider guidelines when it comes to what credit scores they'll allow for the best possible interest rates. So that's also very helpful to people. Obviously, I already spoke about the reduced down payment requirement. They only have it at 3.5% down, which is really nice. And their closing costs with a government loan, since they are government loans, are generally a little bit cheaper than a conventional loan. So that's another added benefit. So aside from 3.5% down, you know, having a little bit cheaper in terms of closing costs, again, is going to save you that upfront cash, which will keep more money in your pocket for possible repairs you might want to do the house, or just, you know, not just repairs, just updates you want to do, or keep more money in that rainy day savings fund, so that you're not kind of totally depleting yourself. And then with a VA loan, that's also a government loan that's backed by the U.S. Department of Veterans. Who's eligible for this type of loan. So it's, you know, either an active duty service member or an honorably discharged veteran who has 90 days of consecutive active service during the wartime, or 181 days of active service during peacetime. You could have served more than 6 years in the National Guard or Selective Reserve, or you're the spouse of a service member who died in the line of duty. So this is another important factor, is that, you know, if you are, say, the cousin of a veteran or something like that, you cannot take advantage of the VA loan because you guys are related. It would have to be a spouse. That's the only way that someone can utilize another veteran's loan. That's if you're a spouse of a veteran. So typically what we do with this type of loan is, when we're getting all your qualification information up front, we also get a copy of your DD-214. What that DD-214 does is it tells us an entire breakdown of your history in the military, and we can send that into the VA because we do have in-house dedicated VA underwriters. We send that to the VA. The VA then will review it and send us a copy of what's called the Veteran Certificate of Eligibility. So now if you're listening to this and you are a veteran, you're probably familiar with the Certificate of Eligibility. You definitely are familiar with the DD 214. So that Certificate of Eligibility, basically what it does is it tells us that you're eligible for a VA loan. And then there are numbers on there which are mostly just important to the bank or the lender themselves, which show, you know, how much eligibility you have. And based on that, we know whether or not we are able to lend to you for a VA loan. So that certificate of eligibility gets us to that point, and we usually qualify you based on what's on there. And the other nice thing about a VA loan is it's as little as 0% down. So, you know, you can do a down payment on a VA loan, but one of the big benefits of the VA loan is that it's 0% down. It's 100% financing. Essentially, all you have to come up with are your closing costs, taxes, and insurance. You know, unless you were to negotiate seller's concessions. But that's the huge benefit, right? 100% financing as long as it's for a primary residence. And, you know, it's one of the types of loans that, you know, that's a great benefit to it, to be able to have 100% financing. And it's a way to give back to veterans by allowing them to keep all that extra cash in their pocket when submitting an offer for a house. So yeah, that's it on the government loans. You can go to the next slide. So this is basically just a breakdown against, again, a bar chart of kind of what you're going to be looking at between your down payment, loan amount, and total interest, from anywhere from a 15-year fixed conventional to a 15-year VA loan, as well as a 15-year FHA loan, and then you have your 30-year conventional fixed loans, and then your ARM, which is an adjustable rate mortgage. In the past, I've been in mortgage now about 14 years, and we have, the whole time I've pretty much been in mortgage, I've really never done any adjustable rate mortgages, and that's just because interest rates have been so low. With that said, you know, rates are starting to climb, so you may have people that are now interested in those adjustable rates. But the big thing to be careful with those is that they adjust after that first 5 years or 10 years, whatever type of adjustable rate mortgage you get. But those types of mortgages can help people that are thinking of maybe moving out of state or will be selling their house within a period of time. We have a lot of people that are doctors that use adjustable rate mortgages. Right now, though, adjustable rate mortgages are not much different than like a traditional interest rate in terms of those mortgages. And the reason being is just because the rates still are low, even though they're going up. They haven't been super beneficial, but everybody has a different scenario, and it's definitely something we can look at. But again, you'll see on this graph the difference in down payment if you're doing 20% down, obviously on the conventional ones. You also, I should note, can do less than 20% down on conventional loans. It just depends on what type of properties you're buying. That 15-year FHA you'll see on there is only the 3.5% down. And then the VA loan, 0% down, which is really nice. And then on top of that, it shows you the total amount of interest that will accrue over the time period of the loan. So what's important to note here is obviously you're looking at differences between 30-year loan rates, not loan rates, loan terms, and 15-year ones. So yeah, there's going to be slight differences, obviously, in the amount of interest you're accruing. If you're doing a 30-year term, it's going to be more interest. That's without a doubt. So yeah, we can go to the next slide. Pretty much it. If anybody has any questions or comments, just let us know.
Great job, Adam.
Thank you, guys.
Yes, thank you, Adam and John. We'll be doing part 4 and 5 next week. So please join us for that. And Adam, can you say your phone number or contact information?
Yep. Yeah, so my phone number, best way to reach me is just via phone. My cell phone, direct cell phone number is 716-913-3914. If anybody wants to look me up, my NMLS number, which I'm supposed to say is 929-545, if anybody needs that information. And then my email, you can reach me at afensky at premiummortgage.com. So Afensky is just A as in Alpha, F as in Frank, E as in Edward, N as in Nancy, S as in Sam, K as in Kite, and E as in Edward at premiummortgage.com. And premium mortgage is all one word. So yeah, those are my contact information.
All right, thanks, Adam. And John, do you mind just saying yours?
Yeah, my best is my cell phone is 716-531-2704. My email address is John Balserzak, all one word.
I'm sorry, John, I think you got muted.
Cut out there.
All right. My cell phone is 716-531-2704. My email address is John, JOHN, BALCERZAK at KW.com.
All right, thank you both so much, and we'll see you next week.
Thank you. See ya.